Welcome to Starting Nowhere. I'm your host, Brandon. Do me a favor and like and subscribe this episode so you can see more Starting Nowhere. Today, my guest is Donovan Brooks. Donovan is a certified financial planner, and we're going to get into what has been going on with all the stock market craziness, including GameStop, Wall Street Bets, and Robinhood. Please enjoy today's episode. Well, thanks for joining me today, Mr. Donovan. Why don't you go ahead and tell everybody a little bit about yourself and how you came to meet me?
Yes, my name is Donovan Brooks. I am a certified financial planner. Oftentimes, financial planner and financial advisor get kind of thrown in the same group, but for this purpose, you can kind of assume that. So I met you via the Facebook group. Obviously, GameStop has been just top of mind for everyone in the stock market, and so I wanted to lean into that and give some awareness around that. So yeah, I'm glad we were able to hook up.
Absolutely. I'm very excited. As I told you when we first posted looking for somebody who want to talk about it, I'm like, yes, thank God. Yes, I've been dying to talk about this topic. And again, we kind of talked about before we got on the air, I'm smarter than the average bear when it comes to finances, but I'm not a professional as you yourself are and stuff. So I couldn't talk about it with lay people because they don't have the requisite knowledge. But I also struggle to talk about it with professional people because they have too much knowledge. And so I think somebody like yourself who's well versed in speaking to idiots like me will be very helpful in going through all this. So let's start there. How did you get involved with being a certified financial planner? What attracted you to that? And then kind of what does a CFP do?
Yeah, absolutely. So to step back, I really kind of started my journey in college where I started off in accounting and decided that wasn't what I wanted to do. Just accountants have certain personalities, they have certain ways and certain desires of pursuing their career. So I got into finance. I really liked that. Double majored in financial services and financial management. And from there, I kind of got headhunted to be an intern at a small investment management firm where I'm at locally. And that's kind of where I cut my teeth in the industry. And that's kind of where I started to evolve and learn more about financial planning. And it wasn't soon after that that I kind of went down the route to become a certified financial planner. So, in short, a certified financial planner is really someone that's going to help you in the main and core areas of personal finance. So, anything that really involves touching your personal finances, certified financial planner should be able to lean in and give quality financial advice in that arena. So, anything from budgeting and cash flow planning all the way up to, talking about estate planning. Now, we can't give legal advice because we're not attorneys, but we can help evaluate different areas within your personal finances, such as maybe the estate planning area. So really pulling all of that together to have a concerted effort towards financial goals and what you value most is really what certified financial planners can help consumers do.
And one of the ways I've always described CFPs compared to like a financial advisor or some of the other people is a CFP tends to be much more holistic. You look at a lot more of the finance world than just your investments and things like that. Even though you do that and you do touch on that, you also look at a lot of different stuff. And that's why I always recommend to people a CFP is probably better for you than a straight up financial advisor. Again, everybody's situation is different. I am not trying to take down financial advisors. I know I have financial advisor friends. Some of them I'm trying to get to come on the podcast. So don't kill me before I get my full statement out. But so let me ask you a couple of questions and then we'll dig into what these questions mean for those who don't know. But are you a fiduciary?
I am a fiduciary. So I have set my firm up as an RIA. And so I operate under the fiduciary standard. Now, that can often get lost in translation for a lot of consumers. And now some of the regulatory agencies have come out with the best interest clause. And so that has muddled it even more. And so it's really hard now to distinguish who's a fiduciary and who's not. A lot of people claim to be a fiduciary and they're not. Their business isn't structured, in a way to operate as a fiduciary. But for all intents and purposes, I am a fiduciary. I've structured my business to operate in that manner.
Okay. And so for those who don't know, that's a good answer, and we're going to dig into that in a second. And then the second question I had for you, and again, if you're uncomfortable answering this, you're not trying to give away your secrets or anything like that, feel free to not answer. But is your services fee based or percentage based?
So I am a fee only advisor. And so I charge kind of fixed fees that my clients can pay me out of their bank accounts, but I also charge fees based on assets that I manage. So pretty much fee only is separate from any type of commission that is paid via a product or other arrangement.
Yeah.
So
Yeah. And so let me tell everybody who's listening right now. Those are the answers that I seek whenever I'm going to look interested in working with somebody on my finances. That I want them to be a fiduciary, and I want them to be fee based. And a lot of people have the wrong understanding about fee based, and I think that that's one of the things I see commonly is that they don't want to pay fee based. They like the percentage based one because they don't actually see it necessarily as much. It kind of goes into all the stuff that's happening. But I primarily believe in, again, I always try to make sure that I clarify my statements. There is nothing wrong with percentage based financial advisors or CFPs. There's nothing wrong with somebody who's not a fiduciary either. I just have my preferences for people who are fiduciaries, and then also for fee based CFPs or FAs.
And I
And
will step back and make a
yeah,
clarification based on what you were saying.
yeah,
And I use language called fee only because this is one of the things I hate about the industry. There's so much vernacular,
yeah, yeah, yeah.
and it's hard for the layperson to understand. There's a difference between fee only and fee based. Fee based can include fees from the services, but that can also fold in commissions, and so
Yeah.
it gets really tricky really quick. So a fee based advisor could be 50%, fees, but 50% commission. So I hate that there's so much vernacular and there's so much contingent on this or that. But I just wanted to make that quick distinction. If you really want to pursue someone that has structured their business in a way that they've minimized the conflicts of interest, fee only is somewhere you want to look for someone in the fee only realm. And
And
I
this
don't
is
want to do this out of a place of like posturing and virtue
no, 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 no.
signaling, because there's definitely fee only advisors that are bad apples, right? There's definitely commission advisors that are good advisors, but
Exactly.
yeah. Now you hit on that too. So I just wanted to make that distinction.
Yeah, yeah. And so this is the first of what I hope is many where you provide additional clarity to someone like myself. Where I told you before we got on, I've said it since we've been on. I'm smarter than the average bear, but I am not a professional by any means. So when I was thinking fee based, I'm thinking fee only. Fee only is what I'm actually talking about.
Mhm.
But you're correct, obviously, in how a lot of those things work. So let me take back what I said a second ago. I always recommend fee only advisors. I think that's that way to go. And the reason I feel that way, and you tell me your thoughts, obviously you set your business up this way for a reason, is because fee only means here's what I'm going to get paid no matter how much money you give me. Here's what I'm going to get paid. And then I'm going to try to get your money to perform the best, right? Because again, you can be a good advisor and not be fee only. However, there's when you're not fee only, you can make money off of the amount of money your client gives you, not the amount of money they make you. Excuse me, that you make your client. And I think that's one of the things that I don't necessarily like as much because if I invest with you $1 million, you get paid the same amount whether you lose me money or making money relatively. Because obviously, as my pot starts going down, you make less money, but nonetheless.
Right. Yeah. Yeah. Great clarifications there. And again, why I always push feeling kind of why I went that route is, like I said, minimizing the amount of conflicts of interest. When you start to get into commissions, people's motives, oftentimes, I don't want to speak in generalities and absolutes, but oftentimes the advisor is motivated to sell something, whether you need it or not. Like
Mm-hmm.
they're trying to provide, I get it. But the conflicts of interest are just really high. So you hear these horror stories of, insurance based advisors that sell people whole life insurance that they don't need, like younger people
Yeah.
that are fine with term life. And you get people buying these loaded mutual funds that come with high and excessive fees, and they buy these mutual funds and they never hear from the advisor. It's because they got paid already. And
Yeah.
so
Exactly.
there's just a lot of conflicts of interest that tend to come with these commission based products and advisors that can be operating in that fashion.
And which is great that you mentioned all that because it kind of leads into naturally. I think the second part of what we talked about a second ago is that you're a fiduciary, and a fiduciary. Let's do this. You tell me in your words what a fiduciary is. I don't
Yes,
want to
yes.
gum it up.
You are fine. A fiduciary is required to act in their client's best interest. And, a lot of people are like, well, I'm an advisor. I'm going to act in my client's best interest. But what sets a fiduciary apart is that there's legal consequences for not acting in the best interest of their client. So, for example, if I have a client and I'm a fiduciary and I give bad legal advice, like there's financial repercussion that they can come after me and seek, you know, to be made whole financially. We all advisors should be carrying errors and omission insurance, professional insurance, but that's one of the big distinctions there is that I can be liable for bad advice and giving bad advice. So that's something that comes with being a fiduciary.
Absolutely. And that's one of the reasons, like I said, I always recommend that to people because you're telling me that you have a legal responsibility to do things in my best interest, whereas the other guy just tells me, I will. right? And so there's nothing wrong with that. The guy who says I will may actually do that, but why not have that legal backing if I can? You know what I mean? And the
Absolutely.
reason for a lot of people is because not always, but fiduciaries, because they have that extra legal ramification for not giving you the best advice, they sometimes can be more expensive. And the same thing with fee only advisors, they can be. See, that's the thing. I can't say fee only advisors would be more expensive. They're more expensive upfront in the way you can see, and that's why people don't go to them, because the percentage based ones, they can't really see that. They know there's going to be a percentage of whatever, but they don't think about it in the long term. So the more money I invest with you and the longer I invest with you, that's a heck of a lot more money than the fee that you wanted me to pay up front for whatever service you were providing.
Right, right. Absolutely. And so, for listeners that are listening that may be going down the path looking for an advisor, uh, it's important, imperative to ask how an advisor gets paid and the amount, and connect the lines there. What's great about fee only advisors, and even get into fixed fee, is it's really clear to articulate this is what you get, or this is what you pay. The other thing you want to ask is like, what am I going to get for what I pay? And those are two very pieces to evaluate. Price in itself doesn't tell you a whole lot. It's really, you want to look at what you're going to get. Warren Buffett was kind of coined with saying, price is what you pay, value is what you get. So as long as the value is there, you're getting a multiple of how much you pay. That's what we want to focus on. And oftentimes advisors don't deliver on that. Sometimes they deliver, and they deliver more. So price is important, but again, make sure you're also asking, what do I get for this? Can you show me maybe something that a template, some sort of case of like, what can I expect to get? All good questions asked.
Absolutely. And you just said something else that got my little antennae spitting up there. You like Warren Buffett? Are you a Warren Buffett guy? Or are you just kind of, you respect him for what he once was, but maybe look for something a little bit more modern these days?
Yeah, I respect Warren Buffett for what he's built and what he's done, and kind of his work ethic. You read stories of how he started working at a young age, and just his entrepreneurial aspirations and what he's done. And so I'm a big fan of that. There's a lot of things that he believes in, pillars and tenets that he lives by, that I think are really important. Like, only invest in what you understand. Like
Oh
that's
my
something
God,
that.
yes.
So he think he's going to be one of the titans that we always look back at.
And that, and again, going back to just my own history on that, I did go to I'm a Berkshire Hathaway B. Let me start there. B stock, and you know what that means.
Mhm.
I'm a B stock shareholder, and so I did go to the conference 2017, 18, something like that, and it's incredible. I love Charlie Munger too, because he's hilarious. Again, they're both really really great at what they do, but Munger is so much funnier than Buffett because he's just a curmudgeon, man. He just, oh, I love it. I love it. He's just so mean.
Right, right. I'm glad you got to go to that. I have a friend that owns some Berkshire stock, B share, and
Yeah.
he tries to go, whenever he can. So yeah, if you can afford to get a B share just to get your pass to the shareholder meeting every
Oh yeah.
year, that it's worth it. So
And so, for those again who don't know, just to finance nerd out of here a little bit more, the reason we keep clarifying B share is because the B share is a $300-400. I don't know what the price is at this exact moment. It's somewhere between $200 to $500, let's say, right? The A share is like $500,000. It is a stark difference between the A and the B share. And also, to be clear, the A share is not for sale very often. It's very, very limited. They have a certain number of it. It's all owned, and it's usually passed down to like different generations. It's like something somebody bequeaths in a will or something like that.
yep, absolutely. And oftentimes the different share classes come with different rights.
Hmm.
Um, and so that's another big distinction between those shares. I'm not up to date on up to knowledge on the different share class and what they mean. Like, but I don't know if I guess you would know. Be shareholder. Do you get proxies? Do you get to vote on a lot of the issues?
No, no, no,
No.
no.
Yeah. So B share may
Every
not
once in a
have.
while, every once in a while something can come up, but really, no, no.
Yeah. So that's yeah, a part of the distinguishing between the shares.
Yeah, but like you said, it's basically it's your pass to be able to go to the conference. It's your pass to be able to just get. It's Berkshire Hathaway. I mean, come on. Like if you're gonna, I and we'll get into this in a little bit when we start talking on some of the really hot topics that are going on in the real world today. But I don't generally recommend buying individual stocks. I am more of an index investor myself and everything. But it's Berkshire Hathaway. Like that's again, if nothing else, if it loses me every dime I ever put into it, it got me access to the conference. I could potentially get access to the conference in the future, and like it's just worth it for that. Matter of fact, some people, I don't recommend this. I do. I think it's shady. Don't do this. It's not illegal. I don't think. I just think it's shady. But some people will. you get access to 4 passes with you having a stock of the B share. One share will get you 4 passes to the conference. Some people go on eBay and sell them. They sell the passes to the conference. Again, I don't think they make much money, or however much money they make, but still, I think it's shady. Don't do that. Just come on, man. It's really not that hard to get a stock. And if you're traveling to Omaha, Nebraska, I think you can afford the stock.
Yeah, absolutely. Absolutely. Yeah. It may not be explicitly listed there, but yeah, let's operate in a moral way when it comes to that. Just they have the means to do that. It's beneficial for the shareholders. Yeah, don't take advantage of it.
Absolutely. So I'm going to use something you said a little while ago as a segue into the hot topic we wanted to get into today. You mentioned, understand what you're paying for, or excuse me. And I think one of the things that I always tell people too is understand how the company you're giving your time or money or your information to is getting paid. And we saw that recently with Robinhood. With Robinhood, when they had to shut down trading, uh, whether you believe in the conspiracy, which I don't, let me start there. Whether you believe in the conspiracy reason that the hedge fund essentially told them to shut it down, that's one thing. Or you believe in what I think is the more realistic answer, which is the clearinghouse and how much they had to take on to get those different trades to close. Either way, you have to understand how the company you're doing business with is getting paid. And for Robinhood, because they're not getting paid for per the service of the actual trades and everything like that, they don't keep a lot of money in their coffers to be able to clear all those trades when it go ramps up like that. They can only clear so many, and then they have to at some point go, hey, we don't have the money to cover this. We don't have the money to cover all these trades that are going on, and we're gonna have to restrict trades because we simply can't pay it. We don't have the money going through. So well, let's start there. What is your opinion on what has been kind of been going on and just everything you've seen from the GameStop situation, or let me just say the Wall Street bet situation, because it's not just GameStop, it's AMC and all these other companies too.
Right, right. I have a I will say I've had a lot of emotions
Mm-hmm.
that have come to the surface. I'm gonna be honest, I probably lost a day or two of productive work just watching all this unfold. Really, I think it's gonna be an interesting event that will go down in history, that we'll see in history books in finance, and will be kind of held up as an example moving forward. To say that this won't happen again, um, I don't know if anyone can say. I could definitely see something like this happening again. So yeah, just everything that's gone on has been really interesting. There's been a lot of themes. I think you said earlier, not a fan of holding individual stocks. That's one of the things that have come to the surface that I agree with you on. That most of American and investors shouldn't hold individual stocks. There's too much risk in that. So buying an index fund, buying the broader market is going to give you the returns of the market with a lot less
Mm-hmm.
risk. And
Mm-hmm.
so someone in a situation like this, and we can get into kind of the how the ups and the downs that have affected these investors, but someone's always caught holding the bag, right? And we're
Yep.
seeing I saw some stuff pop up on the Wall Street bets forums of people that bought in at the top and they sold at the bottom. And it's like that
Yeah.
is the risk of trying to time the market and invest in single companies. So it's really interesting. I know there's two themes of like, okay, Wall Street bets getting into this, like why it's a combination of um, information that these hedge funds published. Like they're short in these positions. They are betting against a handful of companies. One happened to be GameStop, which for people our age grew up going to GameStop. Like this was a
Mm-hmm.
spot at the mall that we always made sure we hit up when we were there. So part of it I think was a personal, our generation took it as a personal attack. They wanted to stick it to these hedge funds. Another part was we had enough with Wall Street manipulating the market and
Mm-hmm.
taking these short bets, betting against these companies, and then using the media to encourage people to sell and saying like, hey, we don't think GameStop's a very good company, like pretty much encouraging the stock to go down, in which they can profit off of by buying shares back at a lower price. And for those that may not know kind of how that all works, like when you invest, you can take a long position or a short position. A long position is when you buy an investment and you are long, you are hopeful of the company and the investment. It's going to grow over time. You're playing the long game. It's some of the same language. The other position is short. You are short. You don't think the company or the investment is going to do very good in the long term. And so what you do is you actually borrow that investment or that stock. You're going to borrow it and you're going to sell it, whenever you borrow it. and then you're going to buy it back when it tanks. And so that difference between what you sell it and what you buy it as, like that's your profit. And so that's what these hedge funds were doing. They bought GameStop, at X dollar amount. They shorted it, they sold it, and then they kind of said, "Hey, GameStop's a bad company. We're going to, issue these sell order, these sell signals and drive the price down and buy back in at the bottom." And then so you get Wall Street bets that it's just totally pissed off. And they're like, "No, we've had enough. We like GameStop. We're going to buy it. We're going to, push the price up and stick it to Wall Street." And so you can't get mad at them. It's definitely, we'll see what happens, like who is on the wrong side of market manipulation. But, Wall Street bets said, "You've been doing this for a long time. Here's a dose of your own medicine."
I think the only thing for me that, and thank you for that, was a very detailed and great explanation of everything that's going on there. I think the only thing for me that I'm interested to see how it ultimately gets handled is the market manipulation that was done by Wall Street bets. And let me be very clear about this. Market manipulation can happen in a lot of different ways, and it's a very broad term. And there are, even though they won't describe it as such because the SEC would is not going to allow it, there are legal ways to do market manipulation. To your point, going on something like Jim Cramer and making a statement, and then a bunch of people do it, that can be viewed as market manipulation. But what I'm looking at Wall Street bets and why I think that's directly market manipulation, and I'm interested to see how the SEC eventually comes down on that or what they do with it, is because you had a lot of people essentially colluding on a forum to specifically raise the price of this stock. Not because they were saying, "Hey, we believe this is a company that we should invest in. We believe this company has a great future." They're specifically saying, "Let's raise the price of the stock," which is almost a letter definition of something like market manipulation. I wouldn't say it's price fixing just because you're not actually trying to set a price. You're just trying to drive it up, which is why people start talking about pump and dumps, which, for those unaware, a pump and dump scheme is basically Wolf of Wall Street. Wolf of Wall Street did it all the time, in real life and in the movie. But you buy a stock, you put a bunch of money, you have a bunch of money, you flood that stock to make it go up. People see it's going up, they start jumping in with all their money, and then at some point, either you have a number in mind or just you feel it out, you jump out. And since you were such a heavy investor that got the process started, you also start the downfall of it. So you get all the benefit of pumping that stock up without having to worry about it being ready to drop because you knew you were doing it from the very beginning. So that's kind of what you started to see now, because we're recording this on, what is today, February 4th, I believe? 5th. Today is February 5th. And this week, GameStop has started to go down. And which is, and again, I'm not saying the people on Wall Street bets did this purposely. I don't think that was their intention at all. As you said, a lot of them had great memories of GameStop. Some of them just wanted to stick it to the hedge fund managers and stuff like that. But at the end of the day, that stock can only maintain a price when people believe it's worth it. It has to have some kind of valuation in the market, or somebody with enough money to swing it can do that. All these different things can happen. But what happened with GameStop is nobody really believed their business model had changed. Nobody really believed suddenly that GameStop was this amazing company. We need to drive this price up. All they all did it to either do a short squeeze, if you view it that way, market manipulation, or just to get back at hedge fund companies, all those type of things. And so it was always going to have to come back down. People were going to sell, and a lot of these investors who got into this are not experienced investors. They've only invested either for a short period of time, or they don't have a lot of money in the market, or a lot of them, which is really scary to me, jumped in specifically just to invest in GameStop. Once all this GameStop fervor started, they all started opening accounts with Robinhood or whatever trader they were or broker they were opening accounts with just to trade. And now that the stock is starting to fall off, they don't have the patience to watch it and to do what I think the internet's calling diamond hands, to hold it for a long time. They started to sell. And so they're locking in all those losses. As you said, somebody bought towards the top when it was on all CNBC, when it was on MSNBC, all these different channels and everything like that. And they bought it, and they're like, "Oh, great, we're going to make all this money to the moon. We're going to, rocket ship this all the way up." And then it started to sell out because what they didn't realize is, one, you came too late. When it's on the news channel, it's almost always too late. It's too late once you see it on TV. You have to get in before it's on TV. And then two, some of the people who are driving it up had tons of money. These aren't poor people. Again, I know the Robin Hood theme has become big, where people are like, "Oh, rob the rich, give to the poor." Some of the people who are investing on Wall Street bets are on Wall Street bets because they trade all the time and they have a sizable amount of money to do it. So you're seeing people who are flooding the GameStop stock with $200,000 investments and things like that. So you're not talking about the mom and pops who ultimately came in later and now are left holding the bag. And that's why I was never a fan of what was going on there. Even though I'm cool with sticking it to hedge fund managers, I'm cool with sticking it to Wall Street. You're doing it in a way that's going to hurt the people who are trying to protect here.
Right, right. And I think, yeah, I mean, you made a lot of great points there. GameStop, and I'm always want to disclose this, like the fundamentals of GameStop is why it's reflected in the stock price of what it was before kind of all this happened. So the stock price should reflect how healthy a company is financially and the prospect of the future. And so yeah, just making that distinction that this pump like this, it got up to like 483. Like that wasn't because GameStop did anything spectacular. They changed operations overnight. Like that was simply because there was this buying frenzy. So I wanted to make that distinction. Like, yeah, like you said, and then also there's a lot of there is a lot of kind of assumption and people believe like so it wasn't just retail investors that were getting in on the
Mhm.
momentum of the uptick. There was when you look at it, there was probably some institutions, some other hedge funds, because hedge funds can have different strategies. Some kind of are heavy into the shorting. Some like have long strategies, and so these institutions that participated, that was probably another reason why they were able to pump it up so high of where it got. But even when we got to the top and on the way down, like eventually people are going to get out, and it reflects in the price going down. People were trying to hold out, maybe see if there was a bigger short squeeze in that was going to happen with some of these hedge funds. And no one wants to get, no one wants to get left, holding the bag and have something worthless. I know a lot of times you get on the forums and people are like, I don't care if I lose everything. Well, it's a lot different. Talk
Yeah.
is one thing. It's a lot different when you start to see some of the losses, happening. So this is crazy. This social media era where you can use social media to be heavily influential, and kind of have this herding mentality. I'm interested to see how the regulation is going to step in and handle this because it is definitely dangerous. It is easy to kind of get FOMO and YOLO and
Mhm.
all those things, and it can be detrimental for most people. That's why buy and hold strategy, where you just buy and hold it for a long period of time, is the best strategy for building wealth over time. Anything that is promising you high returns and these get rich quick schemes, um, they're heavily, they involve a lot of risk, or they are just fraudulent, or they're just not suitable for the everyday investor.
Absolutely. And Warren Buffett has a quote, I think, where he says where he's advocating for index investing, and we'll get into that a little bit later because I know there may be some people listening who are wondering what that is. Um, where he's talking about you want to buy something that you can hold for a long time because these people who are day trading have $3 million teams that are researching all the time or whatever. They have these just big giant teams that are all telling them, hey, here's the information I got from this sector. Here's the information. You're not going to beat them. You'll get lucky here and there, maybe, because that's how it works. When you gamble, you're going to get lucky sometimes, but you're not going to beat them in the long run of things. And that's what you're talking about. It's not just about the money you make in any investment you do, it's the money you keep. And if you're making money over here investing in GameStop, but then you're losing money over here because you got pushed out of the AMC rise, you're going to come out to either a neutral value or a negative value. And that's one of the things I think a lot of people need to be careful with. If you want to day trade, use play money. And I don't mean like fake money because that's illegal. Don't do that. What I mean is use money you're okay losing. You should not be day trading as your primary investment strategy. What I did with my own personal investments, and then when I say investments, I mean directly into the stock market. We can talk about other investments later. Is I had like about I think 5%, around 5% of my portfolio in stocks I directly picked, and just wanted to have some fun and see if I was right. That was it. It was 5%. So I think, and then luckily for me, I was very right, but I didn't want to go, all right, now that I'm writing this, let me dump all the money into it and stuff like that. And I'm talking about 2015, investing in companies like Tesla, Berkshire Hathaway, Facebook, Netflix. But I also, and just what I have to say, because I balance it out, I also invested in Yahoo, which then became Altaba, and then so that one didn't work out. And Whole Foods, which ended up getting bought by Amazon, which was
Mhm.
another company I had. So it's all over the place, and that's the whole point. This stuff is complicated. If you want to invest in a company because you believe in it, make it a small part of your investment portfolio, is my opinion, and then just stay there. Invest in a company because you think it's going to make money and you believe in the company, not because you think it's going to make money.
Right, absolutely. I love exactly what you said. I like the 5% mark. That's a good amount. If you want to take a portion and do some of the trading and stock picking, 5%, I think that's a good number. And if this is like a hobby, like if you get, satisfaction and joy out of doing this, researching companies, like,
Hmm.
this is a good route to go. But like Brandon said, don't use an excessive amount of your liquid net worth to do something like this. This is when you start hearing about horror stories and people, going south with it.
So, when you said you talked about a second ago, and I meant to ask you about it, when you said regulation, do you mean SEC regulation, or are you talking about regulating the social media companies? I just wanted to clarify that.
Which part? Sorry.
Oh, sorry. Yeah. So it may be hard to remember
I
exactly
know
what we
we
were
talked
talking about
about a
there,
lot so far.
but yeah. But you were mentioning that you were interested to see how regulation ultimately comes from all this and what's going to happen.
Yeah, yeah. So yeah, I'm interested to see how the SEC handles everything from how social media has played a part in what we kind of talked about, the pump and dump and the
Mm-hmm.
spreading of just all this information, some of it misinformation. I'm also interested to see how regulation comes down with Robinhood because that has kind of been the sub theme of this whole GameStop mania. And you talked a little bit about the just not having the capital requirements on hand, and that has, I think, been an effect of one, the race to zero for trades, right? Because there's no barrier. It is easier than ever to get on there and make trades, and so volume has been something that was a contributing factor to that. The volatility and the volume is what kind of triggered Robinhood's clearing firm to say, "Hey, there's just so much risk in this. We need you to pony up more money." And again, Robinhood didn't have the capital requirements, and they had to raise money overnight to make that happen. And so, yeah, interesting to see what the SEC does. That SEC is the Securities Exchange Commission that has the authority to kind of work and make, you know, it a safe place for investors and to make sure financial institutions kind of stay in line and are acting accordingly. So, yeah, really interested. I know a lot of people got ruffled when
Mm-hmm.
they cut trades off, and kind of got frustrated. And I was there with them, like, is this a free market if you can't trade? Like, what is this?
Mm-hmm.
I do now get it, as more information has come out about not having capital requirements, because you do look at it, there is a lot of risk involved, with the volatility and the price swings of something like GameStop, and just how much volume was going on. When I say volume, I mean the amount of shares trading hands, the buying and the selling. And there's just so much going on. So I get it. I get it how they would and they were trying to cut off the spigot, right? That's why they stopped the
Yeah.
trading, is they, they already owed a lot of money and capital requirements to their clearing firm. If they would have allowed people to continue to trade, it just would have they would have had to raise more money, like, at the end of the day. So
So, and that's something I wanted to get into too, because I think there's one of the things we've seen with social media, and we don't have to go down that rabbit hole. I just want to keep it focused on where it relates to this situation at hand. So don't feel like I'm going to pin you into a corner to talk about social media, because that's a whole other topic. But one of the things we've seen taking place on social media now is the conspiracy that they were doing it because hedge fund managers were pulling their cords. And I think one of the things that's interesting is where people don't see how instant transactions happen. Spoiler alert, they don't. The transaction's not instant. What's happening is Robinhood is covering it because they believe they can get that money. They have a certain either credit line with a company or whatever it is. They cover it, but it actually takes a few days. I think around anywhere between 3 to 7. I think I've heard. I'm not sure the exact
yeah,
timeline.
settlement is trade plus 2 days. It used to be trade plus three
Okay.
days. So 2 days
Okay.
to make that settlement.
Nice. So Robinhood is essentially when you get that instant transaction that you bought that stock or that you sold or whatever it is, Robinhood is covering you for 2 days because they have that credit line, they have the ability to do that and stuff like that. So when you take that volume and you multiply it by all these different people doing it, they're going to run out, and that's exactly what you saw happen. And I want to say this as carefully as I can because I think it's a much more complex issue than I'm going to make it sound in this one statement I'm about to make. That is one of the dangers or weaknesses, if you will, of trading with a company that has its business built around data as its main source of income, because they're not making as many fees off of actually doing transactions, and they're not making as much fees off their users individually. They may not have the coffers to cover some of these things. And so you're going to only, I would recommend if you want to use something like Robinhood, use it for your dollar cost averaging trades. Your trades you're doing monthly, you're doing reliably, that you don't have to worry about getting restricted. If you want to be a day trader, do not use a free platform. It's going, again, let me say it this way. you will run the risk of running into this happening again if there's a frenzy. Anytime there's a frenzy, this will happen again. This is not some conspiracy where they were shutting it down because we were the man was getting over on the hedge funds and everything like that. It's because they can't cover it, and you're always going to run into that. So if you're a day trader, you need to use a service that maybe charges you a flat fee for unlimited trades a month or something like that. That's what I would recommend in general.
Right. And this was such an unprecedented event. We did see this happen with other custodians. We saw it happen. TD Ameritrade suspended trades just like Robinhood. Schwab did E-Trade. I think when they caught news and they heard of what happened, they're just trying to protect themselves. Like they would go through the same process. Like people were leaving Robinhood to try to buy more GameStop at other platforms. Like we saw the ripple effect, and so it's just a learning event. This hasn't happened really before, at least to my knowledge. And so, just to say it was just Robinhood, it wasn't just Robinhood. It was some of the other platforms as well. And it's just some of the risk involved with what happened. Like people trying to not be exposed to more risk than they can handle. But I agree. Think places and custodians, like when you look at Robinhood, when you look at even TD Ameritrade and Schwab, it's important to know how they make their money now that they're not making their money on trades. And a big portion of their trade, their revenue comes from selling order flow, which is the trades to
Mm-hmm.
what's called a market maker who kind of fulfills those trades. And the optics look really bad. And this is, I think, where everyone got up in arms with kind of the conspiracy theory and, oh, Robinhood's, in it with hedge funds, is because Robinhood would sell their order flow, like Citadel and some of these hedge funds were some of the biggest buyers of that order flow. And
Mm-hmm.
that's when from the outside looking in, the optics look really bad. And that's kind of where I think a lot of people made that deduction of this looks really bad. And it looks
Yeah.
like they're protecting them. So order flow. And then the other is securities lending, the margin. So when people would borrow and short, and participate in that activity, that's another big way that these companies make their money. So I always think it's important to know how they make their money because they make it somewhere. If we're getting free trades, typically we're the product in there somewhere.
Yep.
So it's important to know that kind of stuff.
So, and that's a very important thing that you just touched on there at the very end too, because I've always told this to people. Netflix charges you money to get access to their service, right? YouTube does not. So how does YouTube make money? YouTube sells you ads. It also sells your data, what kind of your demographic. You know what I mean? It's not selling Brandon does X. It's saying a mid-30s black male, blah blah blah, will watch these type of videos. Is interested in these. Give him these ads. That's how they do their marketing, and everything like that. So when Netflix raises its price $1 in the last 20 years or whatever, I don't remember. It's raised it a few dollars now,
Mm-hmm.
a couple times over the past 20 years. Ask yourself how the companies who are free are adjusting to the times. Netflix is making great money. I'm not trying to sell them as some nonprofit company by any means. What I am saying though is that they're a low price product compared to what you used to get. For those old enough to remember Blockbuster, and GameStop's a perfect example of this because it's basically Blockbuster at this point.
Right.
You remember going to Blockbuster and renting three movies, not a month worth of movies or anything like that, three movies, and it cost you like $12. And now in 2021, where with inflation and time value of money and all these other principles, the money is worth less. We are whining about paying $13 to a service that allows you to watch unlimited movies from the comfort of your couch. You don't have to leave the room. It's crazy to me that people don't pay attention to these type of things. But again, they're consumers. They're not necessarily supposed to. You know what I
Right.
mean?
Right.
So one more thing, and then I'm going to let you go again too, because I know I've been rambling for a minute now. In my career field that I used to be in, government contracting, there was a saying, and I think this goes into what you just closed with on Robinhood: perception is reality. So even though Robinhood did not shut down the sales because they were bought by the hedge fund managers and they were protecting their own interests and everything like that, the perception that that happened is what is called at best a conflict of interest, and it's concerning. But you should be concerned about it going forward if that's something that you're worried about. You now know how they make their money. So if you're worried about there being a conflict of interest with them trying to protect the hedge fund managers, if/when this happens again, don't use them. Don't use any company that makes its money that way. And I think you're going to find out a lot more make their money that way than you would originally realized. And that's going to be one of the things you may either create a company from and, hey, make millions of dollars. That's the way to go. Or you realize that, hey, maybe if everybody's doing this, it's not the issue that we necessarily think it is. Or, I don't go down that rabbit hole in a second. I'll let you get it. Sorry.
Yeah, no, I think You make a great point. And that's probably one of the themes that I've been reflecting on the most from this whole ordeal is the conflicts of interest.
Mhm.
Obviously, I've structured my business to operate in a way where I've minimized it. I won't say that conflicts of interest will never occur. We can't
They
get
always
through
will.
life. There's always going to be conflicts of interest, but we need to minimize them when we can, and we need to disclose them fairly, openly, and transparently when they exist. Because what
Mhm.
that does is we need to give the other party a chance to evaluate fairly of do we move forward with this or not. And so one of the things with Robinhood and these other custodians is like we need to know what the conflicts of interest are so we can properly evaluate do we use this service or not. And that's
Yes.
something that hopefully regulation comes in and clears this up. Like we need to get rid of this small fine print, this industry vernacular. No, tell us what we need to know. And so we can evaluate the conflicts at hand. I know again we're not going to fully be able to remove all of them, but it's important for investors and the consumers to know what we're dealing with. And so when we look at Robinhood and their relationships with these hedge funds, like it's good to know that that's how they make a big portion of their revenue. It's also good to know that it affects best execution, which is the process of a trader getting the best price that they can. Well, if your order flow, if the order flow that is going through Robinhood is being sold to a market maker, that's not necessarily going to be the best executed price. And so we need to know these, consumers need to know that this type of stuff exists. The veil needs to be pulled back, and everything needs to be operated transparently. But there's just a lot of money. Money kind of has a lot of influence. So we'll see. And I know I have no doubt that there's conflicts of interest with Wall Street and DC. Like there's there's obviously going to be some conflicts there. So yeah, just really interested. I've just been thinking a lot about the conflicts of interest that exist and inevitably how it hurts consumers and the investors.
Absolutely. And one of the ones I always try to go to with people is like, say, the Fed, right? Um, the Fed, they're like, oh, well, the people who run the Fed came from banking. I'm like, of course they did. Where else are they going to come from? Where else are you getting somebody with the requisite experience of the banking industry without coming from banking? Like, what job is there? And if you have one, anybody out there, please give it to me. But what job out there gives you 30, 40 years of experience about the banking industry without being in the banking industry? I just don't see how some certain conflicts of interest, to your point, can exist. They have to. That's how you get the experience. With Robinhood, if you don't want it, go pay for your shares. Or, you have to do research in the companies you do business with. The thing I always try to keep in mind for myself and tell other people is you vote every day with your dollars. Yes, we vote for president for every 4 years. We vote for midterms every 2 years, like all that type of stuff. But you vote day in and day out with the money you spend or don't spend at different organizations. So if you want to support an organization that doesn't sell your data, go find it. That's what you need to do. And because of the way the world is now, you're going to see a lot more of those companies, in my opinion. You're going to see a lot more of those companies popping up that are openly saying, we will not sell your data. Here's our pricing structure. Here's how we make our money. And none of it's going to involve selling your data. And then at some point they may, and then you could cut chalk, you know what I mean? Or pull chalks and get out of there.
Absolutely. It's funny because it's the pendulum swinging, right?
Mm-hmm.
It's these services that wanted to get access really quickly to consumers that didn't think they could charge anything because they wouldn't have any adoption. That has to compensate. That has to come from somewhere. And we tend to be the product. And now that we realize the magnitude of how this is affecting us, yeah, there is a demand for companies and services that say, hey, no, this is what you pay, but you can rest assured that we're not going to act, against your interest. There's not going to be the same conflicts of interest. We're not going to sell your data. We're not going to do this. We're not going to do that. Interesting to see how the pendulum is swinging. Now we're saying like, yeah, I would pay for a service that operated in that fashion. So really interesting how the pendulum is swinging in that arena. And it's not just the financial services industry. It's, we're seeing a lot, we're seeing it come, in a lot of different areas of life.
Well, and to your point, that I think that's one of the reasons I'm such a big fan of fee only advisors because it's the same thing. What are you paying up front versus what are you paying long term? And that's what we're seeing here. You don't want to pay for those trades because you want to do more trades. You want to encourage day trading and all these different types of things. So you don't, but then you get your data sold. Now they have to shut down trading and all these type of things. Same thing with a fee only advisor, right? You pay the fee up front and then they give you the service and they give you what you paid for and everything instead of charging you continually over all those years and everything. And again, I'm not trying to talk a bunch of crap about people who are percentage based. I'm just giving my own preference. You just have to decide what you want to do. Make the decision to vote with your dollars and which thing you want to support. Is it Robinhood with free trades and knowing what the risks of that are, knowing that they're selling your data? Or is it somebody like Fidelity who, yeah, may have some conflicts of interest because they're a big, old, established broker? They're going to have some conflicts of interest. There's no way they don't. So you just have to decide where you want to put your money in. But the lesson from this for everybody should not be, and I hope it's not, that you don't invest. There's just, I don't think there's any other structure that you can do instead of investing into some kind of Wall Street or real estate or REITs, whatever you want to do, that will make sure that you can retire effectively. Pensions are dead for most companies. You've got to play the game, but you've got to do it in a way that mitigates your risk and is smart. Don't day trade unless you really, really, really are committed to doing that.
Right. Absolutely. I think that's one of the good lessons, hopefully, that's come out of this fiasco is just more information, more education around investing that, everyone should be participating. It is the way to build wealth over a long period of time. Just not focusing on the
Mhm.
single stock and the risky strategies that have been carried out. So I agree. Hopefully this has kind of shed a light on investing, maybe for people that weren't as knowledgeable. So hopefully there's some value there. And then to step back and talking about fee only advisors, and to kind of vote, you talked about voting with your dollars. One of the
Yeah.
great things about working kind of with a fee only advisor, as opposed to maybe a commission based advisor that, is getting paid up front, is that I always tell people I don't have any contract links. I'm not locking you in. Like, I want to work with you and I want you to work with me as long as value is being provided. And the moment that I quit providing the value to justify my fee, you leave. And that
Mhm.
is like one of the most beautiful things about how I've structured my business and how a lot of advisors have structured their business is if you're not getting value for what you're paying, leave. Like, and you're free to go somewhere else. And so that keeps me honest. That keeps us honest as those advisors that have set our business up like that, to always be providing utmost value. Because to be frank, yes, we love our clients, but it costs a lot less money to keep a client, an ongoing client, than to go out and find a new client and a new
Oh
client that
yeah.
we like and that fits our criteria. And so that's just a little peek behind the curtain of just that the benefits in that structure.
Absolutely. And you know what? I don't want to go into that anymore because I feel like I've already started to poo-poo non-family advisors too much, and I don't want to do that. I think it's like you said, it's about the actual CFP or the financial advisor, whoever it is you're working with. It's about them as an individual. It's not specifically about the structure of what you're doing. But the one thing that's always interested me about finances is that I've rarely met a person in my time on this earth who does not want more money, who does not think that they should have more money or in some point. But I have met even fewer people who understand it, who are interested in learning. They're like, oh, it's so boring and blah, blah, blah. I'm like, it makes you money. It's like, I don't understand how this is boring. Like, I could read this stuff for hours and I have. And that's a really sad thing to admit sometimes. But when I was deployed and I first really started having my financial awakening, I was staying up like I was getting a little sleep because I was reading about real estate investing. I was reading about all these different things and everything like that. So when you're working with your client, do you try to do that as well? Not just to handling it for them. Do you try to educate and try to teach them kind of like why you're doing the things you're doing and like provide that service?
Absolutely. There's always an education piece because that's as a CFP and as a quality financial advisor, you want the education there. You want to be able to substantiate the recommendations and why you're carrying it out. A lot of times clients, you know, they're at that point with you. They trust you. They sometimes they don't want to know. They're like, you know
Hmm.
what? I trust you to do your thing. I get that you're trying to educate me. So it's kind of a fine balance where
Yeah.
I do want to educate them. I know the line where maybe their eyes start to glaze over, but some do really want to know and they appreciate it, and that's great. Some people are like, I trust you. Do your thing. I still try to substantiate in a sentence or two like why we're going to do this, just because it's good. It's best practice. As an advisor, even for a compliance purpose, like we need to substantiate why we're doing this. So, and a lot of times that comes through the education. What's also great is when I create content, a lot of that is educational, and a lot of that is
Hmm.
doubled to sent to my clients, and that's a great kind of way that I do that as well. So, but I agree. You need, like I said earlier, you need to understand at least at a basic level, kind of what's going on within your personal finance. Even if you pay someone, you need to know what's going on. So,
Absolutely, and that's why you're a professional and I'm not. Because when those eyes glaze over, I'm like, bring it back in here, because I'm not getting paid for this. I just love to talk about it. So don't you glaze your eyes over on me. We're going through this, and you're going to get better because of it. What's really funny to me is because of all this GameStop stuff. We talked about people starting to get into the market, and I'm hopeful that it hasn't burned out their taste for it. I have a store that's nearby me, and I go there pretty frequently to buy, little snacks or whatever, beer or whatever it is. And I walked in there yesterday, and the guy goes, "Hey, uh, are you investing in this whole GameStop thing?" And I'm like, well, I'm not a big fan of speculative investing. And then we ended up having like a 10-minute conversation about it. And he was like, he started actually like taking notes of what I was telling him and stuff. And you might not want to do this, but I'll do it here publicly. And everybody remember, I'm not a financial professional. You should not take my advice any more than you would take it from some random stranger on the internet. Because for most of you, that's exactly what I am. But I tell them, it's like my favorites are VOO and VTI. Like those are the two, the ETFs that I prefer to do a lot of the time, especially for beginners. Because I'm like, hey, buy it, leave it the heck alone, don't touch it. And I didn't go into the details of it for you and I could say I do think the market's overpriced right now, but building that investing muscle eventually through the dollar cost averaging and everything like that, it'll kind of balance out. Just get in, and don't worry about the timing of the market and everything like that. So I'm hopeful that there are more people having those type of conversations. People who would never even care about investing or think about it or do any of this type of stuff. Because one of the things he did say to me too, because I told him like, hey, yeah, I like to do index investing and real estate. And when he heard real estate, he thought it's like, oh, you need a lot of money to do that. That's big money time. It's like, dude, first of all, I'm not some rich dude. let's stop there. But also, it doesn't take a lot of money to get into real estate. It takes a lot of money to get into real estate you'd want to live in, probably. But that's not exactly what we're talking about. It's not necessarily the same thing. Are you a big fan of REITs? I don't do REITs, and that's mostly because I have actual real estate. But I just wanted to see what your take on REITs are. And I'm sorry, and
Um,
explain what they are too, please.
Yeah,
Sorry.
a REIT is a real estate investment trust. And so it is a company that has structured an investment to hold real estate holdings. And the way that they've structured it and the way that they pay it out, they're able to have some favorable tax advantages to it. So I will say where I came from was a place that used a lot of non-traded REITs. And when I say
Mm,
non-traded, it means they're not publicly traded on a stock market. So you couldn't go on a stock market and buy this public, non-publicly traded REIT. It was illiquid. And so I came from a place that used a lot of those. Some panned out, most of them didn't. Clients didn't understand them. So they were a lot of work. I was the one servicing them, servicing the clients that had them. They were a PIA. They still haunt me. Like when I hear people talk about REITs, I still shiver. Like it goes down my spine. Now there are publicly traded REITs. There are funds that are publicly traded that you can go on and buy, like an ETF, an exchange traded fund or a mutual fund, and it does the same thing. It's invested in real estate, so very different. But for my experience, like REITs are just you know not not conducive for building wealth long term for most people. There's just better avenues for investing in real estate, in my opinion.
yeah, and I'm like I said, I'm right there with you. That's why I've never really paid too much attention to them because I think real estate in and of itself is the way to go for most people. And I think I talked about this on somebody else's podcast. I don't think it was mine, but when I'm talking about getting into real estate and where I'm saying it doesn't involve as much money, I have a property, and I'm not going to tell the location because I don't want everybody to start going there and buying up a bunch of stuff. But there's plenty if you look around the country. Rule number one: you don't have to buy where you live. Stop that. That's dumb. If you live, I live in Miami right now. I am not buying investment properties in Miami. Doesn't mean that they're not available. They just cost several hundred thousands or millions of dollars to do so. Look around. And two, when I was talking about not having a lot, needing a lot of money to get into it, I currently own a property that my car cost more than. You know what I mean? Like that's the type of stuff you're talking about. You can find those deals without having to save up for tons and tons of years and do all that stuff. So you have to stop real. I think we have to stop viewing real estate investment strategies as you buying a house you'd want to live in. That's not the only way to do it. You can do a bunch of different strategies. My preferred strategy is rental. I rent them out, but you just have to look at all these different things. And that's why I invite people, whether it's real estate, whether it's REITs, whether it's index investing, whether it's day trading, whether educate yourself. The education is free. It's out there. Donovan has a lot of free education he gives out. I can name drop some other people, and because I told you before, I used to be a personal finance blogger. I've actually met a lot of these people too, which is really for me it was cool. It's like meeting a celebrity, but nobody knows who the hell these people are.
Right.
So there's Afford Anything was where I really cut my teeth and got started. There's the Simple Dollar, all these different websites are out there. You can read a lot of the principles of what's going on. And I always say this: don't negate the information of somebody who's trying to sell you something, but be scrutinize it. Just make sure it makes sense. Because, like you said, you sell stuff. I'm sure you sell your services and everything like that. Does that mean your information isn't worth anything? No. It just means that you have that knowledge and you're trying to get paid for it.
Right, right. Yeah, I think you're so right. You're going to find a lot of value and a lot of free value out on the internet. And knowing like where it comes from, there's a reason, people want you to stay around. If they're providing value, great. But know that they would love an opportunity to sell to you, and establish a relationship. That's just the part of the deal. And as long as it's clear and concise, and you're getting X, Y, and Z, and you know the terms of it. Just know that. But yeah, exactly. You're spot on.
Yeah. And in general, one of the rules when it comes to finding that free information is the quicker the money, the higher the risk. The quicker the money, the more likely it is that you're being sold some snake oil. It doesn't mean you are. There's always something you can maybe get lucky, but real, like I said, man, if money was quick, everybody would be doing it. That's just really how it works out. A lot of this stuff is you have to have principles of how you actually do it, time in and time out. I'm not going to invest once and then be set for life. It's month after month, it's year after year, it's long term. I think a lot of people, if you haven't seen it before, just type in compound interest example, and that shows exactly what we're talking about. When you invest that first dollar, and then that first dollar makes another dollar, and then so on, so on, so on, so on. That's how investing actually works, and that's how you make the most amount of your money.
Absolutely. I think there's something magical, and I don't necessarily, I don't know. I'd have to look to see if there's any actually evidence, but there's something
Mhm.
magical when you get to about $100,000 in liquid net worth of investments, where you really start to see some of the compounding. If you were to plot it on a graph and look at it, you really start to see something magical happening with compounding around that 100,000 mark is what I've seen and what I've heard other people say. But I think you're exactly right, especially when it comes to investing in finances. If you're under any time constraint, if there's a pressure to act in a certain time frame, that is a red flag, and you probably shouldn't partake, and you should run in the opposite direction, because when it comes to finances, you shouldn't be pressed into making a decision in kind of a tight time frame. That's just, there's too many bad things that can happen in that.
Absolutely, and to bring us back to the hot topic that we originally started to talk about here, and we kind of had this conversation planned for. Um, that's exactly what you saw with GameStop. That's exactly what you saw with AMC. That's exactly what you saw. I forget what the other companies. I think.
It's BlackBerry, Nokia,
Yeah,
Bed
yeah.
Bath and Beyond.
Oh my god.
Dogecoin got tossed in there too. So
Well, and what's funny, and this is uh if he I don't think he'll listen to this, but I'm going to mention him anyways. Shout out to Terry. I have a guy who's a huge Bitcoin advocate, has been for years. He's like he researches
right,
it, knows his stuff about Bitcoin and everything like that. And so he was all for when the GameStop stuff started happening. He's like, yeah, stick it to them, stuff like that. And then they started inflating Dogecoin. He's like, look, guys, Dogecoin is stupid. It's a joke. Do not invest in it. I'm like, yeah, see, at least he's balancing out his information because it's true. Dogecoin doesn't. Dogecoin, GameStop, Nokia, BlackBerry, and this is coming from. I'm going to say something that people don't even understand what this means. Probably up until about 4 years ago, I had a Windows phone. Windows phones were made by Nokia. I can tell you with 3,000,000,000% certainty Nokia is not making a comeback. They're a fine company. They're blue. I don't even know if they're a blue chip anymore. Honestly, I don't think they are. But they're a company who's going to continue to make money. They're going to be around. There is no profit really coming from Nokia anytime soon. The money they make mostly, I think, is from their GPS technology, which a lot of people don't know they own, and they also have a lot of patents for different cell phone technologies and stuff like that. They don't really sell a lot of products these days. So if you don't believe in the company, as we said earlier, don't invest in it because other people are pumping it. If you had the great fortune to do that, get out when it gets on TV, around the time it gets on TV, a little bit after. You just get out of there. And I just hope people stop doing this because it happened in 2008. It happened in all these different time zones. The .com bubble back in 99 to 2000 and everything. If you're watching it on TV and everybody's buying frenzy, if you have that stock, that's about the time you should sell.
right,
If you don't have it, don't go get it. That's
right.
not the time.
Yeah, absolutely. I think, yeah. And when we look at investing, when we look at building wealth long term, investing shouldn't be sexy. Like,
No.
and if there's something super sexy about it, that's a cause for concern. So that's what I tell people. My investment strategies, buy, hold, like it's not sexy, but it's gonna work. It's like,
Mhm.
planting a tree. You put a seed in the ground, you water it, you make sure it gets sunlight, um, you know, you keep pests away, but you don't just sit there and watch it. Like, you go about your life, it does its thing. Over time, 10 years, you start to see some fruit. So it's not sexy. But you said something earlier I wanted to hit on. Investing
Yeah.
can be as simple as, or as complex as you want it to be. And so for
Yes.
people that may be scared to invest, it doesn't have to be complex. And so we talk a lot about index investing, where you can invest in one fund and you can grab, the entire market. Like, it's crazy what Vanguard has allowed us to do when it comes to investing. So you can be participating in something that, quote unquote, has normally been a very complex thing and do it in a very simple manner. So yeah, I just want to empower some people to really think about, you don't have to be super knowledgeable about it. You threw out some ETFs earlier that are quality funds. Yeah, these people that are making it complex, like they're digging into the data. They're being active traders. They're making it complex because maybe they want to, and that's what they're doing with their time. But it doesn't have to be that complex. It can be very, very simple.
Absolutely. Here's the comparison I always make: is fitness. You have people who are out there trying to do all these complicated fitness plans or eating all these complicated diets and all that stuff or whatever. And that may be necessary once you reach those plateaus. That's necessary for guys like Jim Stepani, for back in the day, for guys like Ronnie Coleman, like these elite level athletes of aesthetics, bodybuilding, and all these type of things, whatever. It's not necessary for you when your activity is an hour at the gym and then you work 9 to 5 as whatever job you do and stuff like that. It's not your profession. You don't need to be that complex. You can be, but you don't need to be. And finance is the exact same way. If your 9 to 5 is not finance, you don't really have to worry too much about shorts. You don't have to worry about options. You don't have to worry about all these different complicated tools that can make money. They are not inherently evil or inherently tricky. Excuse me, not tricky. They're not inherently something that will make you lose money. But if you don't know what you're doing, you will. So just stick with the basics, because that's how money is made reliably. My basic principles of finance are this: know what you're trying to achieve, and then do that, and then work towards that every month. If you give yourself a target to hit, there's a million calculators out there to tell you how to hit it. And then you just do the basic investments and don't worry about it. Try to make
Absolutely.
more income. If you need to get a promotion at work or do whatever else, more income and keep more of it.
Absolutely. Yeah. Yeah. That's another thing I like to hit on. You hit it spot on when it comes to investing for most people. Get the quality funds, invest, let it do its thing. And then you need to focus on the things that you can control, the things that are going to bring kind of more value. Like you said, work on increasing your income, things that people don't really think about that are going to can yield a ton of value over time, right? If you can increase how much you can earn, scrutinize spending, like spending time on scrutinizing your cash flow. And yeah, there's just a plethora of other things that even when I work with my clients, that's what I tell them. My investment philosophy is not sexy. This is what we're going to do. It's going to take about 5% of the relationship, and then we're going to focus the other 95% on things that we can control. So, and we're going to take advantage of the downs of the market because we're systematically investing, and over time, we're going to see growth.
Yeah. And so that's one of the things that you said before that I disagreed with it. I wanted to say it. It's like, I think it's super sexy to watch my net worth go up month on month. So I disagree with you that proper investing to me is sexy when you watch those numbers continue to go in the direction you want to. And I'm saying that as somebody who, what's it, 2021 now, so about 6 years ago, had a negative net worth. You know what I mean? So
Mm-hmm.
it's great to see it. First of all, when you go from negative to positive, that's a great sensation. Then watching it go up month on month, I actually calculate it, track it in a spreadsheet every single month. I go and log in at the beginning of the month and see, oh, this went up, this went down, stuff like that. Because that's the other thing that a lot of people get disheartened about. It's going to go down. Your net worth, your investments will go down at some point, at some level. It may not be the entire thing. It may not be a huge chunk or whatever, but it will. That's expected. Don't freak out. It's going to happen. But
Right,
like I
right.
said, I think that's super sexy to watch that happen.
Yeah.
I
No,
love
no.
that.
I was more so speaking to
I know. I'm just picking at
strategy.
you.
Yeah, yeah. The strategy of like the buy hold. There's nothing, no magic tricks that I'm gonna perform. But no, I'm glad you hit on net worth. That is another important thing. I think everyone should be tracking their net worth because it is the metric of progress, right? This is what's going to show how healthy we are and how healthy we are progressing, because it takes into what you own and what you owe, right? And so it is the metric that, yeah, you want to be looking at least year over year on a very minimum. You're looking at year over year, your net worth. And like you said, if you can track it in a spreadsheet, you can have it somewhere. And it's also going to be encouraging, right? It's going to be the wind in your sails when the points when you think the times in your life where you're don't feel like you're making much progress, look at your net worth. If you're doing the right things, if you're doing the right principles right, you're going to see that number grow.
Absolutely. And for those, I'll mention a couple of services that I use that are free. And I believe that the primary way they make their money, because I've looked into it before, is by selling you products. It's not specifically by selling your data. Does that mean they don't? I don't think so. I think they do some selling to advertisers and things like that, but they make the bulk of their money from selling your products. And I'm sure you've heard these terms before, but Personal Capital is my favorite one for tracking net worth, and Mint is the best one for tracking actual budgets and transactions and things like that. Even though for most people, just pick one. You'll be fine. If you're going to pick one, I would say Mint probably because it's better at tracking the actual transactions day in and day out. I just like Personal Capital because I like that little extra level of detail in the investments and how it's tracking the value there. But and that's how I do it. All I do is I go to at the beginning of the month, I go to Personal Capital, which is tied into all my accounts and everything like that, and then it gives me that, like you said, my assets. Excuse me, yeah, my assets minus my liabilities. Boom, there's my net worth, and then I track it every month, and then I know, hey, you know what? I'm taking on too much debt here, or maybe I should pay that down more, or maybe, hey, this investment's going up. Do I need to rediversify? Not rediversify. I'm sorry. I'm
Yeah,
rebalance my investments
reallocate,
into those
rebalance.
type
Yeah.
of things. Like it's just great to know what you're doing month to month, and then also for me, and they've done some research in this. When you start tracking something, you actually start working to improve it. So if you start tracking, say, when you go to bed, you're going to focus on it more. So if you start tracking your net worth, then you start going, hey, maybe I need to reduce my debts, or I need to increase my investments, or I need to increase my income. It gives you something to look at that actually tells you how you're doing month on month, year on year.
Right, right. Yeah, exactly. What gets tracked gets done. Like that's the reality of it. If it's not getting tracked, you're going to pay it no attention. So, yeah, there's a ton of personal financial management tools out there. A lot of them are great. You mentioned a lot of them. And yeah, just like you said, know what's in it for the company if it is free. If you don't care about some of the data that's being aggregated, the transactions and the balances, even just a simple spreadsheet of just listing out your assets, listing out your liabilities, and doing some self formulas to calculate that for you could be, something you look at too if you don't want all of that other stuff going on.
Yeah, you don't need to be me who does all three. I have multiple spreadsheets. I have multiple tracking apps and things like that that I use as well. So you don't have to be me. You could, like you said, there are tons of templates on the internet for spreadsheets that give you your budget, to track your budget, to track your net worth, to track your debts, whatever it is. There's a billion of them, and they're all free. Again,
Yep.
a lot of them are free because they want you to come back and they want you to buy something from them. That's
Yep.
usually the hook. You know what I mean? Which again is my favorite way for hooks. Give me something free, and then like you're really good. I'm going to buy something from you
Right.
now.
Yeah, that whole
Because
freemium model is the way that I think a lot of these companies are seeing for the future. Like we want to know that we're not going to get hosed, right? We want to know what's behind the curtain. Give us something, even if some of the premium features aren't there. We need to experience it. We need to know that it's legit, and then we can take it to the next level. So I think you're exactly right. But again, another area it can be as simple as robust or as robust as you want it to be. So either way.
yeah, absolutely. And so to your point, YouTube is a perfect example of the freemium model for those who don't understand what we're talking about. YouTube is 100% free, but the trade off is you have to watch some ads. Well, if you don't want to watch some ads, you can pay for YouTube Premium or YouTube TV, like whatever. I forget what the service is called now, but they have it where you can pay to stop watching those ads. And so they just want to make their money. They're either going to make it by selling you ads or selling your data, or by you trying to entice you to buy something. Because then it's not them giving you anything for free; it's marketing. It's a marketing budget. That's all it is. So
Yep.
and I
Absolutely.
apologize, like I said, for all the people out there who are tired of hearing me go way deep into this. I love talking about finance stuff because it's so much fun. It's so much of what your life ultimately is going to be. Not necessarily, again, I'm not saying you have to be guided by money, that money has to be the all end all be all for you, but money is options in this
Yep.
world. We live in a capitalistic society. We live in a capitalistic world, I would say, even for those that are dictatorships or socialist countries and stuff like that. Money will give you options to make choices for yourself. You don't like how your government or whatever else is running locally, money gives you the option to move. It gives you the option to not be there anymore. If you don't like your job, money may give you the option to stop working. It may give you the option to retire. Money is options, and that's really all it should be. So if you want to be somebody who's doing all this work for people, charities and things like that, money gives you the option to potentially start a nonprofit. Money gives you the options to potentially donate to a charity or something like that too. It's just options. So I think we need to stop with the stigma of thinking money is evil. It's not. Money is
Right.
only a tool to do whatever you direct it to do. If
Yeah.
you're
I love.
evil, it's going to do evil things.
Yeah, I love exactly what you said. When it comes down to it, money's a tool. It's amoral, right? It's neither
Mm.
good nor bad. It's how we use it. And when we build it up, we're able to use it as such a great tool as to create and cultivate and do the things that uh, create great opportunity for ourselves, for those that are around us. And that's why there's an important, we have a responsibility to account for everything that we have and to be using it in the best way that we can, that's going to create the most value for ourselves and those around us. So
Absolutely. So, what do you think? What do you think is going to happen, and what do you hope to have happen from this situation that we've seen with GameStop, with Wall Street bets, with all the stuff that's going on? Do you think that we're going to see some potential, not regulation specifically against the people who did it, but regulation, like say that you can't short a company past 100%? Because I think that was one of the things a lot of people like was news to them that this wasn't illegal. Is that you could short a company to 140%. I think is what they had their position for GameStop
right.
in. Do you think you're going to see some SEC looking at that because they know there's pressure, there's eyeballs on it now, or do you think they're going to more maybe crack down on some of the people from Wall Street bets?
Yeah, I am not sure. I am not completely sure. I'll just be honest. I'm still unsure what the SEC is going to do, because obviously the shorting 140% has been a huge part of kind of what's going on. When you look at it on paper, common sense wise, you kind of think like there probably shouldn't have been there shouldn't even been possible to short more than what is actually available, because that's what caused the eyes. That's what caused people
Mm-hmm.
to really double down and buy you know the stock, because there was an opportunity. It was a target, right? It was a target for some of the action of what unfolded to happen. And when people saw like there was more stock shorted than available, that financial incentive caused the frenzy. It was like piranhas, right? Piranhas just
Mm-hmm.
fighting over something in the water, and obviously it sent a ripple effect. And thankfully, it was isolated to just Robinhood. But think about if it was more widespread, some of the catastrophic events that could have happened. I just think back to the financial crisis and um, the dominoes, when the dominoes start falling, and if it's in the right order and the right institutions, like it could be interesting. So um, some people think like shorting's an essential part of the market and price discovery and keeping hedge funds and people honest. We'll see. I'd be interested. I'm not versed enough in that area, but I would love to have some wiser and smarter people make a debate about if this is something that needs to be regulated.
My only, let's say, concern, and I'm interested to see, is if the SEC starts to take the position of protecting people from themselves, where let's say, uh, so to manage other people's money, I believe you have to have what, Series 6, Series 7 license or something like that, or
Yeah,
to be a
so to
broker.
to to be a broker, to be a broker, you need to have a Series 7.
Okay. And so is there a Series 6? Am I making that number up, or
No,
is
a
that
Series
something else?
6 is another license. It's more, I believe it's more geared towards insurance,
Okay. Okay.
selling insurance products. So there's 6, 7. To give financial advice, you need a 63 and a 65 or a 66, which is a combination. So to give investment
Okay.
advice.
Gotcha, gotcha. But I'm using those descriptions to say basically there are certifications out there currently for what hedge fund managers do. That's one of the reasons that hedge fund managers and other people can do the things they do without being seen as legally, excuse me, illegally manipulating the market and things like that. Because they have these certifications, because there has been a system set up where you have to take these tests, you have to have these qualifications to do certain things. I'm concerned that the SEC may sometime in the future, and I think because of the political pressure, that's the only hope we have to not make it happen, is they start making more of those to keep lay people from doing things like options. And I'll get into something that's a little morbid here for a second. And I'm not sure if you saw this story. I imagine because you pay attention to the financial sector, you may have. But there was a young man last year also using Robinhood, I believe, who was doing some options trading and things like that. And I think his account ended up being like negative $700,000 or something like that. And unfortunately, he ended up taking his life. And so I'm wondering if the SEC is at some point going to start trying to require certifications for certain types of investing, for certain types of trading, which again, I'm hopeful that because of the political pressure that's on them right now, because of the swell of anger from the what they call Main Street investors, that they won't, because they are already feeling like the game is rigged against them.
Right.
But I could see them doing something like that as well to try to protect people from themselves, because that's one of the things they always go to, and I think the optics on that are terrible.
Right, right. I agree. I think, yeah, man, that is such a tough subject. I think we need to be careful about creating more barriers to keep people from pursuing things like this. And even as you look at like careers and occupations, oftentimes there's licenses and hoops you got to jump through to get to point A to point B if you want to be it. And so when I think about barriers, we need to be careful about those barriers, but we also need to think about the protection. Like you said, there needs to be if we're not gonna regulate and have some sort of process license that people need to go through to get appropriate options trading or complex financial strategies. There needs to be some other requisite that isn't going to be oppressive in nature. That is equally it's equal in obtaining it.
Mhm.
Because I just think about that. That is a horrible case of what happened. And I know a lot of that went back to how Robinhood gamifies their app, and they've gotten a lot of pushback. And there's even some lawsuits by I think it's Massachusetts that is
Mhm.
filing has an open lawsuit with Robinhood because of how they've structured their app to be gamified, to be addictive, to really hook people on trading and being involved because that's how they make their money, right? So there needs to be some reform there. I know there, yeah, it's complicated when you get all that tied up in there. But I also know I saw something. I don't know if you saw this, but the Robinhood's CEO has no regulatory license that most
Yeah.
CEOs have to have, and everyone's kind of like baffled, like there's no supervisory license that he doesn't have to report to FINRA, who's kind of who regulates. It's like he doesn't have that. Like, why not? And so that's another thing that's going to be in the spotlight. So
Well, let's talk about that for a second. I hadn't heard that, so thank you for sharing that. I had not heard that, whatever. But um, I've never heard of that certification or that training that a CEO needs. Is that for financial CEOs or is that for CEOs in general, en masse?
it's financial, and it's a series. It's a series license, kind of like we were talking about.
Okay, gotcha.
And briefly, when I looked at it, obviously it's not a requirement, or else he'd be breaking the law. But when you look at it, it's best practice. It's best practice, and it is something that he should have had, regardless. Like he is in a position where he should have been supervised by FINRA, and he should have possessed a license. And yeah, just the fact that something like that happened, it just leaves a lot of people scratching their head, like, how did this happen?
Yeah.
So, and obviously
Well,
something he's probably changed in that arena too.
well, that's interesting because I think again, I know nothing. I'm not an expert on this. I literally heard about this 30 seconds ago or whatever it was that you said it. So I'm speculating here, but I'm imagining that because he is a tech CEO is the way that they classify it, not a financial CEO, because Robinhood, to the best of my knowledge, does not provide any financial advisory services. They are merely a platform to trade, and I
Right.
think they're unique in that way. Well, were unique when they really became big and started going. I think Webull and a few of them other ones do it now. Where most of the services you're going to see, they do provide some kind of financial advisory service. They do provide some kind of where there's actually selling you packages and those type of things. So that's probably a loophole in the
Yep.
way that the FINRA and everybody else and that way that stuff works because you're now seeing that hey, well, you've injected some of the tech industry into the financial industry. So if you are fintech, you maybe should have some of those certifications and best practices. The reason that best practices become laws because of people like this who don't do what the best practice is.
Right, right. Absolutely. I think you hit it spot on. It's probably a loophole that hopefully is addressed now and closed, being kind of in the fintech space. So, yeah. I mean, unfortunately, a lot of the learning events, these educational moments, happen because of some pain and suffering. So we'll
Yep.
see. We'll see what happens. Yeah, it's something to be hopeful about. Obviously, as we advance kind of the common good and protecting investors and creating a healthier environment for people to equally participate in the stock market. But we'll see. Sometimes it just doesn't swing in the favor of the people.
Absolutely. And I'll make a prediction. And since this will be on the internet, I can get held accountable for making this prediction now and see what happens later. I see the SEC dealing with the Wall Street bets people one of two ways. The first way, and I believe the most likely way, is they do nothing because they know what the optics on that are. They know that even though these people, I think from my perspective, and I'm no legal professional, nor am I a financial professional, it certainly seems to fit the definition of market manipulation. Because they made a colluded effort to raise the stock price. They didn't say, again, they didn't, and it's all recorded on the internet, so they can look at what you said. And I think that's where ultimately the people could get in trouble. But again, I think they're going to let it pass. I think they'll put out a statement. They'll try to enforce, some kind of, not enforce, excuse me. They'll try to encourage these people to pay attention to what they're doing and don't do anything like this again. Uh, or the flip side of that is the other way I could see it going, and I really hope it's not this, is they'll make an example out of a handful of
Yep.
people. They're not going
I've
to
heard
go
of
after
that.
everybody.
I've heard of that.
They'll go after like 5 or 10 of
Right.
these people and really go the people who initially posted or who
Right.
were saying let's do this or whatever it is. So I'm really hopeful that those people don't, because again, if you now again, let me say this: if these people go through all this and then they keep doing that, yeah, absolutely, they're going to come
Right.
down on them. You can't just keep letting that go.
Right. Right.
But what we're seeing in the awakening that's done for the world, and the awakening that I think it's done for a lot of people, and what people feel has happened compared to maybe the facts of what has happened being so separate, I don't think that they'll risk it. I don't think that they'll take the political pressure to go out there and make that statement when it's really already done.
Right.
And unless these people again are going to continue down that path, you're not going to try to make an example and take the hit for what that's going to do to you,
Right.
unless you
And
think they're going to.
here's the risk if they do try to make an example and they do kind of go down the road and try to prosecute some of these retail investors with Wall Street Bet. If they do that, there's going to be eyes on them about what they're going to do with hedge funds, because
Oh yeah.
what's happened is what hedge funds have done behind closed doors for years, like the collusion aspect of it.
Mm-hmm.
The stuff, I mean, it happens on, we're seeing it happens on both sides now. So you can't address one side if you're not going to address the other side. So I'll be interested, if they do try to prosecute on a retail side, it's like, well, what are you going to do
And
on the other side? So
well, I'm glad you mentioned that, because that's one of the things that I've been thinking about, and I'm interested to get your take on it. Like, I think the rub there is, and this is where something can be wrong but not illegal, but it also something can be illegal but not wrong. So, and here's why I say that: with hedge fund managers, because they know what the laws are, they are doing it in a way that they can't be tracked back to them a lot of times. So it's really tough for the SEC to pursue them for something like market manipulation or collusion if they're not posting it on the internet. On the flip side of that, because these individuals did post it on the internet, it's in a place where you readily can see it. It's hard to look at it and go, hey, we can't punish you because we're not going to punish a hedge fund manager. It's like, well, you got to catch a hedge fund managers. They caught Martha Stewart. She got caught for insider trading. And one of the examples I always like to go to, and I don't know if this name will mean anything to you or not, I imagine it will, but Martin Shkreli, the farmer bro, as they call him. He became famous because, or infamous, I should say, because he raised the price of, which is HIV medicine, or was it cancer? I always forget which one it
yeah, it
was.
was some sort of drug
Yeah.
that,
So
yeah,
some drug for some terminal illness. He became infamous for raising the price like 7,000% or something crazy like that. But here's the rub: that's legal. He didn't break any laws by doing that. What he ultimately went up to jail for was financial fraud, was fraud. The same thing that all these guys end up getting caught for, it seems like, whatever. So that's why I say this is important, because the hedge fund managers have to get caught for it to be legal. Where Wall Street Bets could get itself in trouble, and where I want people to be careful, is you're openly doing it. You're
right,
writing it down. You're making it where the government and everyone else can see. And if they're going to take that position of, hey, letting this one go and then maybe getting you the next time, it's not right. But it is the
right,
fact of the legality. You can't be out there openly colluding and
right.
saying what you're doing and it being illegal.
Right. Yeah. The plans were very overt, right? You can hop on
Yeah.
the subreddit. Anybody can read it. Hedge fund managers, it's a little more covert what they're doing. Now, if there's a reason to investigate, there's typically a paper trail for everything. So they could pull the thread and find something. But I agree. Hedge fund managers have kind of been doing what they do, but we use hedge fund. Not all hedge funds are bad, right? But the ones that are, operating in a nefarious way have been doing it behind closed doors, and they've been doing it in secretive fashion and doing it in ways that probably could be you know pretty gray depending on how it's perceived and how it's looked at. So
Mhm.
yeah, yeah, it's just it's a tough spot. It's a tough spot, but I'm interested to
Absolutely.
see how they rule on this and what they pursue, if they pursue anything. But hopefully again, I'm always a proponent. I want to see something better off than how it was. So hopefully, if whatever route the regulatory environment goes, hopefully it's going to leave it in a better position than how we approach this whole fiasco.
Absolutely. And here's one story I like to share. And there's no way in the world that you don't know what I'm about to say. Excuse me, you won't, when I say it, you won't have heard it or whatever. But for people who don't know, Hedge fund managers don't really make a lot of money for their clients. A lot of them actually lose money for their clients. And Warren Buffett was so sure of that he bet them. He said, "I will put $1 million in an index fund, and you can use all your tricks, your tips, all your information, everything you know to actively manage your $1 million. And I bet you that the index fund will beat you." And only I think a handful, three or five, took him up on it. Three of them dropped out after like 2 years or something like that because they were getting killed.
Right.
And then the one or two that stayed to the end got massacred. I'm gonna look it up and hopefully put in the notes of this episode and everything. But the hedge funds got killed by an index fund. And all he did, again, Warren Buffett did this: one buy, leave it alone. Never looked at it again, didn't do anything with it. These guys are out there researching, they're trying to trade all these things or whatever, and they did not make money. They lost to the index fund. And so I only say that to say this: when you feel like the game is rigged, in my opinion, yes, money gives you options that other people may not have. So there is some slight privilege there. However, active management is a lot of times not the best option. And hedge fund managers don't really make a lot of money for their clients a lot of times. But now you're getting it. If you want to get complex, they do that on purpose sometimes because you can, what's it called when you take the losses? You realize the losses so it can lower your tax
Yeah,
for
capital
that year and
losses.
stuff like that or
Mhm.
whatever. Yeah, thank you. Thank you. But just, I say all that just to say that index investing, the thing that I'm recommending, and I believe Donovan's kind of recommending, he's also recommending a lot of other stuff, like working with him, obviously. But is a great way to make money. It's a great way no matter how much money you have, no matter what your goals are and everything like that. So don't feel like you're being shorted by not getting access to hedge funds. They're not necessarily the best option for the majority of people, including those people who are in them.
Right. Absolutely. And most of the time, there's minimum requirements for those hedge funds. They're working with high net worth, ultra high net worth people. And there's a reason why. Like when you look at their fee schedule, they charge a lot of fees. They charge a percentage of what they managed. And then they'll probably charge, I believe they set up their structure where they charge a percentage of the gain that they make in a period of time. So there's a lot of fees associated with it, which a lot of people would probably call speculative. But even if you wanted to, there's probably a good reason not to. But they do have high barriers to even get into those, and for a lot of regulatory reasons too. So
Absolutely. So I know I've yacked your ear off now for about 90 minutes and I want to get you out of here, but before you leave, I want you to do two things for me. One, leave the listeners with a tip. One of your favorite financial tips. It's very easy, very palatable for them, and everything like that. And then at the end, of course, add that. Tell people where they can find you. They can hear more of you. They can get the information that you're. And if they want to, sign up with you to have a financial planner relationship with you.
yeah, absolutely. So my tips, my tips are just like my investment philosophy, not sexy, but time tested. And so I'm a big fan of like spend less than you earn, and I'm sure you're kind of gonna nod your head at all these. Spend less you earn. That's the only way to really get ahead, to build margin, to build wealth long term, is to make sure you're spending less than you earn, and that comes back to being proactive and serious about budgeting and tracking. Now, oftentimes people have a very mixed emotions about budgeting and having a spending plan. You go back and forth. Whatever it is, you need to know what's coming in, what's going out. You need to make sure your spending is intentional and aligned with your values. However you want to spend it. So that's what I would say there. Avoid the use of debt, like minimize the use of debt. We can't fully, break free of debt. We're going to need debt to buy a house or what have you. But the quicker you can get out of debt, I think and view it as an investment in itself, because there is an interest rate attached to it. But even psychologically and emotionally, relieving yourself of debt is a huge piece. Yeah, building margin and saving, set goals and create the processes that are going to get you to those goals. So goals are a great direction to head into. They can change. Life changes, goals can change, but you need to set the goal so you know what you need to do today and what you need to do tomorrow and the next day and the next day. And if your goal changes, great. But then it sets the stepping stones of what needs to happen today to get you to that place. I love the quote that says, "Aim at nothing and you'll miss it every time." Or aim at nothing, you'll hit it every time is the
Mhm.
quote, and that's so true. So those are some of my tips. Again, not sexy, but time tested. Like you look at everyone that is thriving and kind of built wealth. I'm guessing they've probably taken some of those principles and applied it to their personal finances.
Absolutely. And like you said there, that my number one tip that I try to tell people is like, how do I be successful? How do I make money? What's success? What are you trying to make money? What is money? You know what I mean? Money is not a thing. Making $500,000 in net worth, that's a thing. Making $1 million in net worth, that's a thing. set a target and then reach it. What's success for you? Is it a job promotion? Is it a certain degree? Whatever. You have to establish what you want to actively work towards it. So tell people where they can find you if they want to hear more from you.
Absolutely. There's a lot of places. I'll just give you my personal website. It is donovanbrooks.com, and I'm sure we'll make sure it's in the notes. But if you want to learn more about my podcast, my financial planning practice, it's all routed through there, and my social media as well. So that's kind of the one-stop shop, donovanbrooks.com.
Absolutely. And so, everybody, please make sure that you look up donovanbrooks.com. He has a ton of information for you out there. I know that you don't like to hear me stumble through it. So, go listen to somebody who is a little bit more polished on it and has, all the degrees and certifications, everything like that in it. And make sure that you're being smart with your money. Make sure that you're thinking about your money. But thank you, Donovan, for joining me today, man. I really appreciate it. I really appreciate you coming in here and trying to make sense of all the meme stonks and everything that's been going on lately and the nonsense.
It was a pleasure, and I'm glad we could continue to educate and spread some awareness.
Thanks for checking out today's episode. Leave me a comment and let me know what you thought about our interpretation of the GameStop situation.